A virtual investment committee works around the clock: a news analyst, a fundamental researcher, a chart technician, a risk manager, and a portfolio manager, all AI agents. They read filings, debate ideas, and produce a daily trade recommendation. Projects like TradingAgents, ai-hedge-fund, and FinGPT package this dream into open-source code. But here is the question that separates genuine research from elaborate demos. When all 5 agents say buy, is that 5 independent votes or one language model parroting the same news 5 times? Dissects the architecture, exposes 4 fatal gaps between language fluency and predictive power, and offers a concrete checklist to evaluate any AI trading agent project. A common pitfall is mistaking role labels for cognitive diversity. In a real multi-manager fund, each analyst might use distinct models. One reads satellite imagery, another tracks supply chains, a third models options flow. Their disagreements carry information because the inputs differ. When you spin up 5 prompts on the same large language model, seeded with the same news articles, the outputs are highly correlated. The debate may look rigorous, but it is often one statistical bias wearing 5 different hats. That said, we should not dismiss these tools entirely. They shine in a narrow, high-value task, rapidly transforming messy language into structured fields, extracting revenue guidance, margin trends, and capex plans from a dozen documents in seconds. This is real efficiency, but it is data preparation, not alpha generation. This is the most seductive trap. After a stock rallies, an agent can write a flawless paragraph about re-rating of growth. After a crash, it explains why the move was overdue. That retrospective fluency feels like understanding. But a trading signal must be codified before the event occurs, and then tested across hundreds or thousands of independent observations. A story that sounds convincing is just that, a story. Only a signal that exhibits a stable information coefficient, with a significant t-statistic and low decay, can form the basis of a strategy. The difference is the difference between journalism and forecasting. We need a common yardstick. Researchers often use the information coefficient, the correlation between a forecast and what actually happens. If an agent claims to be bullish, we need to record that precise numerical score before the market moves, then measure how often high scores coincide with high subsequent returns. A compelling narrative might produce an IC indistinguishable from 0. This single number, estimated cleanly on data the agent has never seen, is a brutal but fair test. If it fails, no amount of eloquent writing will fix it. In production quantitative systems, the model must be frozen. Same weights, same hyperparameters, same data snapshot. AI agents built on LLMs violate this basic rule. A minor tweak to the system prompt, "You are a cautious fiduciary," versus "You seek high-conviction opportunities," can invert a buy into a sell. Temperature settings alter the randomness of token generation. Even the order of context paragraphs can sway the conclusion. If a strategy's output is highly sensitive to variables that have no economic meaning, it is not a strategy, it is a lottery. Professional systems must version lock the prompt template, the model, and the random seed, and log every inference for audit. We can turn this sensitivity into a stability index. Take 20 ways to ask the same question, analyze with a focus on downside risk, versus evaluate potential losses, and see if the agent consistently labels the same stock as attractive or unattractive. If half the rephrases switch the recommendation, then the output is dominated by linguistic noise. The lower the index, the less likely the signal reflects genuine information. This is a straightforward engineering test that every serious agent project should publish. In price-based strategies, a single misplaced timestamp can be caught by simple logic. In text strategies, leakage is far more insidious. A news article published at 3 p.m. might be ingested by the agent and used to generate a trade recommendation timestamped 2:55 p.m., simply because the data pipeline used a later crawl. Moreover, many financial documents get revised, earnings releases are updated, analyst reports are corrected. If the agent reads the corrected version while pretending to be in the past, it is essentially cheating on the exam by reading the answer key. The only valid historical simulation must reconstruct, point by point, the exact corpus of text that was public knowledge at that nanosecond. Even if an agent demonstrates a modest edge in direction, that is perhaps 10% of a working trading system. The other 90% is a series of harsh engineering decisions: how much capital to allocate given the estimated alpha and its uncertainty, how that position interacts with the rest of the portfolio's factor exposures and sector bets, where to place the stop, and what to do when the execution algorithm encounters slippage or a failed fill. Most agent demos stop at a buy-sell recommendation. They never confront the realities of market microstructure, capacity constraints, or intraday risk management. A suggestion without a sizing function is like a navigation app that tells you to go north but omits speed limits and traffic. A simple, explicit sizing formula forces the agent to state a numerical edge and a numerical uncertainty. This converts a vague, strong buy into an operationally usable quantity, shares, contracts, or notional. Without this, the agent lives in a world of abstract adjectives. The formula also forces a conversation about risk aversion, a parameter that must come from the fund's overall mandate, not from the agent's mood. Calibrating and testing this mapping is the only way to move from an interesting chat to a repeatable source of P&L. Before spending months integrating an AI agent into a live trading pipeline, subject it to 3 empirical hurdles. First, force it to compete against embarrassingly simple baselines, a buy and hold of the index and a naive momentum strategy. If it cannot beat these, extra complexity is just extra expenses. Second, run ablation experiments, switch off the fundamental analyst, then the technical analyst. If dropping a roll boosts net returns, that roll was creating a false sense of thoroughness. Third, test stability by replaying the same historical day multiple times. If the output bounces around randomly, the agent is not a decision tool. These tests do not require a PhD, only a disciplined backtesting framework and intellectual honesty. The honest role for these agents is not as an unsupervised automated teller machine, but as the outsourcing layer of the research team. They can speed up manual drudgery, reading 100-page documents, standardizing filings from different jurisdictions, and drafting first-pass strategy notebooks. When approaching live trading, a 3-layer isolation is essential. The agent produces only natural language opinions, a separate numerical model calibrates those opinions into auditable signals, and finally, a hard-coded risk engine holds the veto, enforcing position limits and maximum loss thresholds. In this architecture, the agent adds value without being given the keys to the execution engine. The final decision always rests with deterministic, tested rules. Multi-agent AI trading frameworks offer a compelling simulation of institutional process, but simulation should not be mistaken for validation. Shared models, shared data, and prompt fragility mean that 5 agents saying buy often carry less independent information than a single well-tested statistical factor. The 4 gaps, narrative versus probability, prompt sensitivity, information leakage, and the opinion-to-position chasm, are not minor footnotes. They are the difference between a fascinating demo and a deployable strategy. The next time an AI trading platform shows you an eloquent debate, ask for the out-of-sample information coefficient, the prompt stability index, and the fully costed backtest against a simple benchmark. If the project cannot provide those numbers, it is still narrating, not predicting. Thank you for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.